Since 2018, Chinese venture capital flows into the United States have plummeted by 90%, marking a fundamental reset of the global financial architecture. However, conditions may be set for further deterioration. As reported by the Financial Times, Washington is currently engaged in an internal debate regarding Tencent's future and its multi-billion-dollar investment portfolio within the American market. This scrutiny moves beyond a single tech giant. It signals a systemic review of the Tencent model, a decade-long strategy of providing silent, high-volume liquidity to the U.S. technology sector. Tencent's influence on the American tech stack is evidenced by its significant stakes in companies ranging from Epic Games and Riot Games to Reddit, Snap, and Tesla. As one of the world's most prolific institutional investors, its capital has historically functioned as a non-voting foundation for high-growth firms. A regulatory shift toward forced divestment would necessitate a massive reallocation of equity across the startup ecosystem. This creates an immediate valuation floor risk for both publicly traded and private technology leaders. The underlying structural threat is capital by association. If an institutional anchor like Tencent is designated a national security risk, the scrutiny inevitably shifts to the limited partner structures of major venture funds. Tier 1 funds, such as Sequoia or Matrix, which have historically integrated capital from Chinese entities, now face a landscape where the origin of funds is weighted more heavily than the return on investment. This creates an unprecedented compliance layer for the private equity industry. For the startup ecosystem, the withdrawal of a major competitive capital source suggests a long-term liquidity contraction. Historically, the presence of global LPs drove valuations higher through competitive bidding in late-stage funding rounds. A fragmented market, restricted by geopolitical vetting, likely leads to more conservative deal terms and lower exit multiples. This represents the transition from a borderless venture era to a localized, security-focused investment framework. By 2026, the bridge for cross-border venture capital appears to be entering a phase of permanent decommissioning. The ongoing deliberations over Tencent act as the final indicator of this decade-long retreat. When investment risk is dictated by a firm's national origin rather than its performance data, the era of global private equity officially concludes. The ledger is clear. Geopolitics has replaced ROI as the ultimate auditor of Silicon Valley's balance sheet.